I think a lot of people just haven't participated in this market. That's part of the reason. And a lot of people complain about what the Fed is doing. Eventually, when that ends, that's what they're concerned about. But what I really want to stress is, since it is Fed Day, is the importance of the Fed on the markets, how influential they are. And I'll give you three examples.
Good.
The fourth quarter of last year, when Powell came out in early October, said we're going to raise 3 or 4 times over the next year. The market couldn't handle that. Too much debt in the system, whatever the reason is, and we had a huge decline in the fourth quarter. That's example number one. Then he comes out in early January and says we're going to be patient. And that helped that's what helped fuel this rally we've seen so far this year. Third example is he comes out in their last meeting in May 1st, and the market was hoping they would hint towards a cut, but he said we're going to remain patient. And then we saw a pretty ugly May. It was down 6.5% in May. So the point I'm trying to stress is how important and influential the Fed is on the market.
Yes, but just because, Joe, the market wants to see a cut, they like that adrenaline hit, if you will. Does that make it the right thing to do?
I'm not saying it's the right thing to do, but what I think...
I'm not sure what they're seeing out there that they've obviously got something on their radar, which is making them think they need that. My theory is that we're in a global economy. It's no longer the U.S. just isolated thinking about what's going on here, meaning... We've been in 10 years of a globally coordinated effort to keep interest rates low and the markets high. Then the U.S. economy starts to improve better than other countries, and we start to raise rates. But as they say, when we sneeze, the rest of the world gets a cold. So now other countries are in a recession. So I think part of the reason the Fed needs to cut rates is to help the global economy, because there are other parts of the world that are struggling. Well, you know, listen, you are here on the worldwide leader in business news. And you had a tweet yesterday.
Oh, no.
You said, I love how everybody hates this market. Then you continued on. I think the bigger question is, why are people so bearish? My guess is they listen to the news too much, which is usually negative in order to get higher ratings. By the way, not untrue.
No offense.
No, it's okay. Listen, I'm in this. I get it. Do you think there? And I'm putting you on the spot because I know you can handle it. Do you think there is too much agita around sort of the day-to-day about what's happened with bond yields and Deutsche Bank and all this other stuff?
I think that you know.
And by the way, I would agree with you in some respect.
When do you turn on the Weather Channel? You don't turn it on when it's 75 degrees and sunny. You turn it on when there's. That's what part of the news does. Is
well, good, because it hasn't been 75 and sunny for about a year and a half.
That's a good point. It doesn't stop raining. I'm going to build an ark soon. But the part of the reason is that the negative news helps fuel the ratings. But the point is that too many people are being macroeconomists. They're not. The bottom line is, and I said this last time, the big institutions control the markets. And the big institutions have been supporting this market. They're not selling. Earnings and interest rates are the main two drivers of the markets. Interest rates are low, as we talked about, and earnings have been slowing but still steady.
And by the way, the pool of capital out there, the number of available stocks continues to shrink. Big pool of money going after a smaller pool of assets.
Exactly. So my point is that we've consolidated the gains from earlier this year. We're still going to consolidate, but if we get rate cuts as well as a possible resolution from China, I think it takes us higher later this year.